welcome to the Monday Futures Market Outlook for March 25th, 2013. This is Patrick Sresna. As always, we start off with a chart of the US dollar index futures, and the US dollar continues to consolidate off the 83 level up above as it tries to rally up into that zone. It continuously has a little bit of profit taking off of there. Really, at this stage, a lot of the US dollar strength is primarily being based on whether or not there's further euro weakness. The Cyprus situation now being resolved is certainly, at least initially, leaving us to think whether or not the euro is going to bounce a little bit off of those previous lows. If we see any euro pops or any euro continuation on the upside, that may leave room for the US dollar index to actually continue to consolidate back down to support lines. Even if it does consolidate, we don't believe that it's the beginning of a new US dollar downtrend, so we would be looking for support for buy on dip opportunities if there was any further selling. If for whatever reason the euro began a brand new sell-off, let's say some new twist into the Cyprus scenario that looks like it was bailed out, that would leave room for the US dollar to break out all the way to 84 and a quarter, but at this moment there's no technical reason to believe that that is imminent. So when we take a look at that euro, you can see that the euro even a week ago was trading as low as the 129 level, but really at this point has sideways consolidated and has actually tried to bounce a little bit, especially now that the Cyprus situation at least has had an 11th hour solution. The question really is that will that motivate buyers to come back and take the euro higher now that that situation has been resolved? And that's going to be a really important tell for us. At this stage, there's no reason why we can't see strength back to 131 or 132 on the upside, even if it's robust enough back up to the 133 level. But if we see that the euro can't muster up those rallies, that will inevitably be a sign that at some point the euro will deteriorate again. So we'll watch to see how that continues to shape up. Next year, I want to take a look at that 30-year Treasury bond. There's probably no more one contrarian play that we've been trying to call here than this one. It is a pretty broadly accepted thing that the bonds will head lower as interest rates need to head higher in this healthy economy, and there's a substantial amount of special guests onto shows that are suggesting that bonds have a substantial wave of downside. We, on the other hand, have been looking to see whether there will be short-term bottoms in these treasuries that actually could leave room for it to gravitate to the top end of the range. At this stage, while we are looking to see whether that does develop, we want to be mindful of the fact that the treasury bonds have yet to prove to us that a new uptrend is underway, and so therefore we have to respect the existing downtrend. At this point, there's a little bit of selling coming in early this week, but so long as it doesn't break to lower lows, we are going to continue with our theme that the treasury bonds can still rally. If we see that the price action is deteriorating all the way back down to those previous lows and is consolidating there, then we're going to start to rethink whether or not we are way too premature on trying to play a bounce on this 30-year. One way or another, at this stage, we are strategically long, looking for that rally higher, but we are at a stage where we need this market to prove to us that we're going to stick with it. Next year, when we take a look at copper, copper has broken below its November low, but never made it all the way down to its summer low of 2012. Really, at this stage, copper remains predominantly weak, and there's no evidence that a new uptrend is underway. We're going to watch to see how the consolidations and rallies all develop in the upcoming weeks to see whether or not copper has seen a bottom. At some stage, there will probably be a legitimate buying opportunity of copper down at these lower levels, but I think it's far too premature to be already making any assumptions based on the last weeks of price action. So let's watch to see whether or not major support develops here over the upcoming month. Next year, when we take a look at crude oil consolidating more or less around the 94 level as we go into this morning. This is going to be a crucial test. We do believe that we were looking for a bounce in crude oil, but we do believe that this 94 to 96 level is a material overhead resistance. That unless crude oil was very seriously beginning a brand new uptrend, this is a place where crude oil could very well fail in the upcoming weeks. And so while we still don't want to rule out the possibility it goes from 94 to 96 on the upside in the next week or so, really want to recognize that this overhead resistance is material, significant, and can't be ignored. And if we see reversals of crude oil in the upcoming weeks off this level, we will have to be looking for the short on crude. Next year, I want to take a look at gold, and gold has been a real mixed bag at this point. And we have seen major support hold, but at the same time, there hasn't really been any legitimate money flow into gold bullion, and so we sort of have to take a very middle of the road stance on positioning ourselves on gold. We do believe that this is an amazing risk reward proposition of where to own gold, but we really want to identify when the new uptrend has begun, and we still yet have any evidence that that something very robust on the upside has become underway. And so we are going to watch it very carefully here. At this stage, if we do get some early selling this week, the one thing we're going to watch is whether or not gold makes a higher low. The one thing that would sort of throw a wet towel on top of this rally here would be or attempt to rally would be if gold broke all the way down and broke to a lower low. If we saw that kind of price action develop, then that means that we have to wait yet even longer for the chance that gold will really solidify a bottom. But at the same time, if gold here, let's say, sells off to 1590, 1580, but immediately reverses back up and is trading back above 1600, 1610 on the upside a few days later, then we really know at that moment that gold is going through some form of an accumulation phase. Finally, I want to take a look at the S&P 500, and there's only one thing that I wanted to really emphasize in this scenario. While the fact that the Cyprus situation has been resolved, it kind of puts this risk-on trade back to be talked about with the upside of the S&P, which in this moment we can't rule out, can maybe even go as high as 1580 where the all-time high lay. But the one thing we do want to stress is the fact that after the fiscal cliff, there was a very robust rally on the upside. Even after Italian elections, there was a very robust rally that followed. Really, at this stage, while we have seen a rally start up after the Cyprus situation was resolved, it really doesn't have any meat on the bone. We are up 6-7 S&P points off of the lows before this news. So really, at this stage, this really is showing that the market is tired, and that the buyers may not have as much juice left in the tank as they did in prior periods where they were ready to accumulate. This is a very dangerous thing to watch, because if everyone's expecting a risk-on trade after the Cyprus situation, but yet nobody turns around and rallies, and no one is rallying the market afterwards, then the traders will use that as a reason why the S&P needs to be sold. And so really at this stage, it's a really prove it to a scenario where if the market breaks higher, it needs to prove that it really is sticking, because if any rallies fail and turn into selling, that would be a bad sign for the market. Very quickly, just to review our key intermarket observations, we remain very neutral on the U.S. dollar. While we don't believe, in order for us to be bearish the U.S. dollar, believing that there's a short-term risk, that would imply that we see a robust room for a robust rally in the euro, which we don't. At the same time, the U.S. dollar has reached some overhead resistance levels, and the risk-reward of owning it is average at best. Similarly with commodities, even though they are at the bottom of their ranges, in fact, at some stage, the risk-reward of owning commodities commodities will be very good. We are reluctant to want to become very excited about commodities, as traditionally would need some material U.S. dollar weakness in order for commodities to be in a position to do very well. And so while they are at good price levels, we don't see a lot of the catalysts in place for commodities to have robust expansion that makes that risk reward good. We remain bullish U.S. bonds, but like we were suggesting, it's a very much a scenario where we needed to prove to us that our thesis is going to work. If we need to see those 30-year Treasury bonds break to higher highs at some point and really follow through on some of that. If we don't see that, then we may have to rethink that positioning. In regards to both U.S. stocks and global stocks, while we remain in a very distinct uptrend, and we don't want to deny the existence of that uptrend, nor that it really is the dominant trend, the risk reward of owning the stock market is very poor. The amount of risk you have of being in versus the upside potential is, in our eyes, not worth the risk of being in it. That doesn't mean that the market can't rally for another week or two, or that we won't be at a higher price level over those weeks. It's just simply the risk you're taking in trying to seek further gains from the market is not good. And so we'll watch to see where and how the tops develop. That was your Monday Futures Market Outlook. Thank you for joining us.